All right, let's get right to it. Today, we're stepping into the shoes of a professional analyst to conduct a full-scale, institutional-grade breakdown of JPMorgan Chase. We're going to walk through the exact process, from the ground up, to build a complete investment case. Let's begin.
You know, most analyses build up to the big reveal. We're going to do the opposite. We're starting with the conclusion. This single sentence is the powerful thesis we're about to dissect. It basically claims JPM is a triple threat. It's a high-quality company, it's trading at a great price, and it has powerful momentum. Our job now is to see if the evidence actually backs that up.
So, here's our game plan for today. We'll frame the thesis, then run JPM through a tough quality screening. After that, we'll get into its valuation, its growth, and how it's been performing, and then the best part. We'll translate all of this into an actual investment playbook before we give the final verdict.
So the big takeaway from all this analysis is a strong buy rating. But look, a rating on its own is just an opinion, right? It's meaningless without the proof to back it up. The sections we're about to go through are the building blocks of that proof, where we really kick the tires and see if this strong buy holds up.
Okay, so here's a crucial first step in any disciplined investment process. You don't ask, is it cheap first? You ask, is it good? Before we even glance at the price tag, we have to make sure JPMorgan is an institutional-grade company. And to do that, it has to pass 3 non-negotiable quality tests.
First up, the Zacks rank, which basically pulls together what all the top analysts are thinking. JPM has a number 3 hold, which is good enough to pass our first test. But what's really interesting here, the thing you want to pay attention to is the trend. 6 different analysts have actually raised their earnings estimates in just the last couple of months. That kind of positive shift is often a huge sign of good things to come.
Second, liquidity. You know, for big institutional players, this is a non-negotiable. And JPM? It passes with flying colors. It trades an average of almost 10 million shares a day. That's nearly 200 times the minimum we look for. It basically means you can get in and out of a huge position without moving the price against yourself. That right there is the mark of a true blue chip stock.
And finally, we look for what might be the ultimate seal of approval. Are the insiders, the executives, putting their own money where their mouth is? Well, over the last year, insiders at JPM have bought over $51 million of their own stock. That isn't just a number, it's a massive vote of confidence from the people who know the company better than anyone.
All right, so JPM has passed our quality check. It's a solid, institutional-grade company. Now we can ask the big question. What's it worth? The core argument here is pretty simple. We've got this top-tier company that seems to be trading at a surprisingly low price. Let's dig into the numbers and see for ourselves.
The number we're going to anchor on here is the trailing price-to-earnings ratio, which is sitting at 15.72. Now, by itself, that number is pretty useless. Its real power comes when you put it in context.
And here is that context. Just look at this. Compared to its peers in the financial sector, JPM is trading at a 15.5% discount. But then you look at the whole market, the S&P 500, and wow, it's a massive 45.2% discount. This is exactly the kind of valuation gap you look for. It suggests you're getting a best-in-class company for way less than the market average.
So we've established 2 things. It's a high-quality company, and it looks undervalued. But there's a third piece of the puzzle, and it's absolutely critical: growth. See, a cheap stock that's just sitting there, that's not a bargain, that's a value trap. A great investment has to show real growth and a history of beating the competition. And you can see JPM's growth engine really humming when you look at its earnings per share, or EPS. It's been climbing steadily, with year-over-year growth hitting over 24%. Now, this is a super important point. The stock's price is going up because the company is actually earning more money. It's not just hype. That's the sign of a healthy, sustainable rally.
And the result of all that fundamental growth? Well, the numbers speak for themselves. Since the start of 2023, JPM has returned over 131%. It's not just keeping pace with the market, it's absolutely demolishing it. We're talking about outperforming the S&P 500 by 87 percentage points and its own sector by 30. JPM isn't just playing the game, it's leading the pack.
Okay, we've covered the what and the why. Now it's time for the how. This is where we turn all that analysis into a concrete, actionable plan. This is how a professional would think about actually putting money to work here.
First things first, you gotta define your targets. What does success look like? The analysis lays out 3 possibilities. Our main focus, though, is the base case, which sets an expected price of $370 a share. That represents a potential upside of 16.6% from here, and it's based on pretty reasonable assumptions.
Next up, how do you actually buy in?
Well, a pro doesn't just jump in with both feet. The smart strategy is to scale in, or dollar cost average. This plan recommends building your position in 3 different price zones. That way, if the stock pulls back a little, you can actually use that as an opportunity to buy more.
Now, this might be the most important part of the entire playbook. Managing your risk is everything. You have to know your exit plan before you even enter the trade. No exceptions. This plan sets a hard stop loss at $295. If it hits that price, the original idea is broken and you get out. Period. At the same time, it sets clear targets to take some profits off the table as the stock moves your way.
So, we've looked at the quality, we've analyzed the value, we've confirmed the growth, and we've laid out a professional playbook. Now, it's time to put it all together and deliver that final verdict based on all the evidence we've gathered. At the end of the day, every single investment decision comes down to this simple question: is the potential reward worth the risk? Let's do the math. According to our playbook, the risk down to our stop loss is 6.9%. The potential reward up to our base target is 16.6%. That gives us a really attractive risk-to-reward ratio of nearly 3-to-1 in our favor.
And so, when you put it all together, the solid fundamentals, the attractive valuation, the strong momentum, and that favorable risk profile, the analysis comes to its most definitive conclusion: a 5-star strong buy and accumulate rating for JPMorgan Chase.
And that leaves us with one last really interesting question to chew on. When you find a company that's a clear leader in its field, but it's trading at this kind of a discount, is that the golden opportunity this analysis makes it out to be? Or is it a warning sign that the market is pricing in some risk that we just can't see yet? That's the real question at the heart of this whole thing.